All right, hello everybody. Today, as of this recording, is July 14th, 2022, and I wanted to discuss a trade that I just did so I can kind of show you live what my thinking is, what things look like, how to kind of analyze trades as the day is going, and hopefully you can see what it looks like because it looks very different after the day is over and you're looking back on a day versus what it looks like live. So I wanted to show it to you as it's happening so you can get a good idea for your trading. So what I did is I sold a call spread against the market. And you can see the particular strike price that I chose at this particular red line. The market is currently 37.48, as you can see down here. And my strike price for the trade is 38.05. That is this price that I do not want the market to end above by the end of today. This is a zero DTE trade, which stands for 0 days to expiration. So the expiration for my trade is the end of this day. The trade was placed at 12:25 p.m. And so I've only got about a little less than 4 hours for this trade to work. So I wanted to discuss why I picked this particular trade and what my thinking was, what my evidence was to support the trade, and what my trade plan is and how I execute my trade plan. So I like to have at least three pieces of evidence to support a trade that I want to do. So my piece of evidence for this particular trade, the first one, was that the stochastics, which you can see down here, had started to cross below the 80 line. So this line right here, where the area starts to turn purple, is the 80 line, and you can see that number right there. And the lower side is the 20 line. Typically, when the market is above the 80 line, that indicates overbought conditions, which basically is another word for saying the market looks expensive. And below the purple area, that's where we call it oversold, where the market starts to look cheap. These are prime areas to start to look for market reversals. But the trick is you don't want to look for a reversal when the market starts to cross above the 80 line or just crosses below the 20 line. You want to wait because the market can definitely keep rallying and rallying as it did here. So you can see the market crossed above the 80 line here on this candle, this red candle right here, but it just kept going up and then it had a strong bar right in the middle of it. So the key is that you want to wait and be patient for the market to start to cross back into the purple area, which is what you can see right here. So you can see I placed the trade on this particular bar when the bar was just forming. It was on the high side at that time. And I went ahead and placed my call trade here at this particular point. Um, so that was one piece of evidence. Another piece of evidence has to do with the economic news that's going on right now. So currently in the market, we are in a pre-recession state. The market is very depressed and has been all year. So inflation is kind of driving the market right now. Inflation and rate raises from the Federal Reserve. So today is Thursday the 14th. Yesterday, we got inflation data that shows inflation is still higher than what we want. It's higher than expected. As you can see right here, 1.3% versus expected 1.1. And then this morning, we got further bad news on inflation, where the wholesale side, the business side of inflation, is still elevated as well versus what was expected. And we also got unemployment claims that were higher than expected as well. And that points for not so good news for the economy as a whole. It's not really bad news. It's not, starkly bad, but it's not good. It's not what we're looking for. So the market is a little bit depressed. Seeing that, my expectation is that the market is going to continue to be depressed because we are going to anticipate, because these numbers are bad, that the Federal Reserve is going to be more aggressive when it comes to raising rates. And because of that anticipation, the market is going to stay a little bit on the depressed side and not want to rally as people brace for another Federal Reserve hike that's more on the aggressive side. So I knew that all day, even coming into this. So what I did is I waited for an opportunity for the market to try to rally and then cool off from a rally that it tried to do. And that was this opportunity right here. So as we can see, the market has continued to trail off since then after it tried to rally. Now that's evidence number two. Evidence number three, which gave me the green light to try the trade, was this red line right here. This red line is denoting the pivot points for this particular day. And pivot points is something that I teach in the class that are very important to traders. And they're almost like magic lines. You can see a pivot point right here. You can see a pivot point right here. And these are kind of rallying points for the market that likes the market likes to pay attention to these particular lines. So when I saw the market rally and kind of fail and falter at this particular pivot point, that is another piece of evidence that the market is paying attention to this pivot point and using this as kind of a ceiling or a resistance point for the day. So the market has shown that it's having trouble when it gets to this point in the pricing. So now that I have my three pieces of evidence, I was clear to trade. So I went ahead and placed a bear call spread right here at this point when the market was at 37.60, and I made my strike price 38.05, which is this red line right here, and this is the expiration time, which is at the end of day today. So the trade has a little bit less than 4 hours to work. And what I like to do is I like to draw a line between where I place the trade and where it expires at the strike price. What this gives me is a diagonal line that gives me a trend line to follow as the day is progressing. And what this does is it allows me to see, is the market trending to take out my trade to be for me to end up in the money, or is it trending for me to expire worthless, which is what I want. So right now the market is trending below my diagonal line, which means the market is trending to have me expire worthless. Now, if we get a rally and the rally comes above my diagonal line, that means the market is currently trending to expire with me in the money, which I don't want. So what this helps me do is it helps me visualize, even if the market is kind of going up right now, is it going up far enough to get me into trouble? Now, this isn't a perfect thing. So if the market were, like, let's say right here, and the market was below my trend line, I would still be worried, because at the end of the day, the market tends to do some crazy stuff and it can move very fast at the end of the day. And this is a little bit too close for my comfort. But down here on the opposite end, if I just place my trade and the market is rallying above my trend line here, I'm not as worried, because I still have a lot of time, I still have a lot of space, and the market can, it can move a lot around in a particular area. So like if I just place this trade and the market were to rally up a little bit above my trend line, I'm really not that worried. So this isn't a hard and fast line. It's more of a guideline to help me understand where I'm trending versus where the market is currently headed. So this is basically how I trade. I place this trade on my phone, but I'd like to use this particular software to kind of track things out throughout the day. But this is what I'm kind of paying attention to, and this is what I'm looking at. And what I also did, which is very, very important, I went into this trade knowing exactly where I'm going to exit and what I'm going to do if the market does whatever it does. So, my plan for this particular trade is to take it all the way to expiration. So, I don't plan to exit at 50% profitability or anything like that. And if things start to go against me, what does against me look like to the point where I'm considering exiting the trade? Well, oh, there's an alert right there. Um, so for this particular trade, I decided that if the market gets to the 37.75 area, which is about this area right here, then I'm going to look at exiting until maybe around 3 o'clock. Then I'll kind of raise that number a little bit. But if the market gets to 37.75 prior to 3 o'clock, then I'm probably going to look at exiting the trade. I'm not going to automatically exit the trade, but that's where I'm going to start looking at it and considering my options. And I will have my finger on the trigger to exit the trade, of course, but not necessarily automatically exit. But that is my plan. If it gets to 380 before 3 o'clock, I'm probably just going to go ahead and exit. The reason why I'm going to exit at these numbers is because the way that the actual trade looks or works during the actual trade, if the market were to rally up to this point right here, the 37.75 area, my trade would probably be, will definitely be at a current loss, but it wouldn't be a bad loss. So I've allocated a certain amount of capital to this trade. And if the market were to rally up to this point, I would probably lose maybe about 10 to 15% of that capital, or be at a loss of about 10 to 15% of that capital. Let's just say I have $1,000 on the line just to make it easy. Well, I'd probably be at maybe a $200 loss at that point. And let's just say I'm only trying to make $100 or $50, $75 off of this particular trade. A $200 loss is about all that I want to bear on this particular trade if I'm risking $1,000. Reason being, I can easily make up for that on subsequent trades. Maybe even today, I could place another trade and make up for some of that loss. But if it starts to go above $200 in the loss category, it starts to get harder and harder to make up for. So I don't want to take, too big of a loss. And that's one of the most important things that you can do, is keep your losses low so that you can recover from them. If I lose half of that $1,000, that gets much harder to recover, than 20%, 15%, or something like that. So I want to take my loss early so that I can still make up for it. So that is probably going to be around this point. I know that from experience, but if you don't have that experience, then of course you just want to have your trade up. And if your loss gets to, around that area, you want to start considering going ahead and closing out that trade and keep that loss small. But I know from experience that if the trade gets to about this level, this far away from where my strike price is, I'll probably be somewhere around a 15 to 20% loss this early in the trade. And it's going to change as it goes on later on in the day. And to understand why that is, you want to understand how the Greeks work, how theta works, how delta works, how gamma plays out during the day. And you can find information on that elsewhere in the class. But suffice to say that things don't stay the same throughout the day. They kind of change their nature throughout the day as time goes on. So this early in the trade, I'd probably be at about a 15%, 20% loss. Um, as we get to probably about 3 o'clock, things start to change, where I can have a larger buffer or I can have a smaller buffer, just depending on where things are. So like if it's say 3 o'clock, which is about right here, and the market is, trending up to the 37.85 area, then I might still keep the trade on, where earlier I would definitely exit the trade if it was going up that fast. But again, as we get to later, I don't want the market to be like 38.01 and my strike price is 38.05, because the market can easily traverse that distance with in a second. So the calculation changes again once you get closer to the end of the day. But this diagonal line helps you keep track of all of that. Right now, things are going very well for me. I have a buffer in the trade now, where if we get a small rally in the market or something like that, then I'm still fine. Right now, I'm going to keep my eye on this pivot point. I want to see if the market breaks through this pivot point again with any strength. And if it breaks through this pivot point with strength behind it, then I might consider closing the trade early or something like that. But those are my calculations. Another thing I look at is the high for the day, which is right here, 37.70. If it breaks to a new high, that's another consideration of, do I want to go ahead and exit the trade? If the market starts to make new highs, then that means that it could be building strength. And that's not what I want to see in this type of trade. I want the market to stay, somewhat subdued, somewhat suppressed and sideways, at best, or whatever. I just don't want it to be making new highs on me. So those are things that you want to consider during the trade. And again, definitely keep your economic calendar up. I keep this website up at all times, so I know what's coming up. I know what's happened. I can kind of gauge the mood of the market by reading these numbers and kind of seeing what the market's paying attention to. And right now, inflation and the Fed interest rates are in the driver's seat. So when those numbers come out, I want to pay attention to those, because that's going to tell me what the mood of the market is and what they're, anticipating and what they're scared of and everything like that. So this is a live trade, and we'll do more of these. So stay tuned.